Let's talk about making money with day trading and how the MACD can be your secret weapon. The MACD, or Moving Average Convergence Divergence, is a simple but powerful indicator. It helps you spot momentum shifts in any market: stocks, crypto, Forex, you name it. Think of it as a speedometer for price trends, showing you when momentum is building or fading. Instead of guessing, the MACD gives you clear visual clues for potential entry and exit points. It works across all markets, so you only need to master one tool. But remember, no indicator is perfect. The MACD isn't a crystal ball. It's about stacking the odds in your favor, not guaranteeing wins. Combine it with good risk management and a solid plan, and you'll have a real edge. Learn how to use it, and you can time your trades much more effectively. Ready to see how it works? Let's break it down. Scene transition. When you add the MACD to your chart, you'll see three things: the MACD line, the signal line, and the histogram. The MACD line reacts quickly to price changes, showing short-term momentum. The signal line is a slower moving average, smoothing out the MACD's moves. The real action happens when these lines cross, hinting at possible trend changes. The histogram? It's a series of bars that show the distance between the MACD and signal lines. Bars above zero mean upward momentum, below zero means downward. Taller bars signal stronger momentum, shrinking bars mean it's fading. Together, these three give you a clear snapshot of market strength and direction. No more guessing, just a visual system to help you make smarter trades. Let's see how to use these signals to buy or sell. Scene transition. The most common MACD strategy is the crossover, a bullish crossover. MACD line crossing above the signal line can signal a buy. The histogram flips from negative to positive, confirming upward momentum. If those bars get taller, the trend is strengthening. For a bearish crossover, the MACD line drops below the signal line, a possible sell. The histogram flips from positive to negative, and longer bars mean momentum is picking up downward. These crossovers give you clear, rule-based entry and exit points. They help take emotion out of your trading decisions. But don't rely on them alone. Let's talk about avoiding common MACD mistakes. Scene transition. 11. The MACD is powerful, but it's not foolproof. False signals happen, especially because the MACD lags behind real-time price action. Never trade on MACD signals alone. Always confirm with price action or another indicator like RSI. If the MACD says buy but RSI says overbought, think twice. The MACD works best in trending markets. In choppy sideways markets, it can give lots of false signals. If the chart looks messy, it's often best to stay out. Always check the bigger trend on a higher time frame. Trade in the direction of the larger trend and use the MACD for timing. This approach dramatically increases your odds of success. Now, let's see a real-life example of the MACD in action. Scene transition. Imagine you're watching a stock, let's call it TechCorp, on a 15-minute chart. The daily chart shows an uptrend, so you're looking to buy. The MACD line is below the signal line, and the histogram is negative. Momentum is down. Suddenly, the MACD line crosses above the signal line, and the histogram flips positive. You check for confirmation. Price bounces off support, and you see a bullish candle. You enter a buy trade, placing your stop loss below support. As the price rises, the histogram bars grow taller. Momentum is strong. You hold the trade, letting profits run. Later, the histogram bars shrink. Momentum is fading. The MACD line crosses below the signal line, a bearish crossover. You exit the trade, locking in profits before the trend reverses. That's how you use the MACD for smarter, more confident trades.